Liz, you think we're still going to see new lows in this market? You're not convinced?
I don't know that we're going to see new lows. I think that we could see another low, and there's a couple reasons for that. And I want to preface this by saying that I don't think that this is something we should terribly fear. We still need to get to a point where the business cycle resets. The economy is out of balance, and Fed Chair Powell has pointed that out over and over again, and he's been clear about the fact that it's still out of balance. And they're not going to be comfortable until it gets back into balance. But a couple of reasons that I still think we're going to see another type of low, and remember, bottoming is a process. We're getting there, but we're not quite there yet, in my opinion, is that I don't think it's any coincidence that we started to hear commentary from Chair Powell today that he's mindful of the risks and that he's practicing risk management and looking ahead at where the risks might be right around the time when what's called the near-term forward spread inverted again. And that is what the Fed watches very closely as signs of recession. So we've been inverted at the 2s, 10s for a while. We've been inverted at the 3-month, 10-year for a while. But that near-term forward spread is really what the Fed looks at. And it did invert again. Very, very small, but it's still inverted. And that's something that I think really changed the way that they're managing risk.
Yet again, I think it comes down to this whole soft landing question and what you think is ahead for the economy, a deep recession or something more shallow and mild, and what's being priced in. Because it appears that the Fed is going to keep going until inflation comes down to much lower levels than we're at right now. So what do you think is already priced in on that front, Liz, and where do we go?
Well, I think the rally today is very clearly a Fed rally. It's a rally based on the idea that the Fed might end up being a little bit easier than we originally thought, or easier than what our worst case scenario had been as market participants. But we can't have it both ways. We can't get an easier Fed with an economy that stays exactly as strong as it is right now. And I think that's what the market is today pricing in, is that the economy will stay as strong as it is today and that the Fed will be able to come off of this very hawkish stance. The only thing that's going to bring them off that hawkish stance is if demand does in fact relax to a point that inflation cools, if the job market also relaxes to a point that makes them more comfortable. If those two things happen, then the Fed slows down, but those two things will affect GDP growth. They will affect consumer spending. They will affect corporate earnings. So I still think that there's weakness to come both on the economic front and on the corporate earnings front. But what Jay Powell did today was basically reduce the risk that they would put us into a catastrophic recession. So he's acknowledging the fact that he doesn't want to do this. He's not going to hike rates with reckless abandon, right? So he reduced the risk that they were going to create a Fed-induced catastrophic recession.